First of all, I want to thank you all for joining us. This is Mitch Messer with Home Pride Properties, coming to you live from the sprawling metropolis that is Clovis, New Mexico, to do another in our series of Deal Deep Dive Lives, where we perform an in-depth financial analysis of a real estate deal that does not suck, that actually makes sense, and that will keep you out of trouble. This is our sixth one. And if you're here, it's because most likely I invited you. And so I'm glad that you're here, that you could make it. I hope that this next hour and change is going to be helpful to you. And I will say before I forget that Karina is going to be running a poll, probably right around nowish, that you should see pop up on your screen. Just some information we'd like to get from you so that we can see if we're hitting the mark with these. So as that's happening, I'm going to let you answer that and then move on to the beginning of the presentation. If you've seen one of these before, you know how or if you've seen the replay, you know how this works. I'm going to do a quick presentation on financial analysis, and then we're going to dive into the deal for this week with our guest presenter. So let's do that. Hopefully you're seeing your poll question and answering it. So let's get started. So this is the agenda. I'm going to give the ground rules now. They're very simple. My request is that you mute yourself until we get to the Q&A where we talk about the specific deal, and that you hold your questions. I'll stick around here as long as people have questions to ask within reason. So anyone that's got a question will be able to get it addressed. But I kind of want to get through the flow as quickly as I can so we can get to the good stuff. And my hope is that you have come prepared to talk about this deal. This is not intended to be entertainment. This is intended to be a workshop for us to all get better at our deal analysis skills. Deal analysis is what keeps you out of trouble, and in some cases will save your bacon. If you are with me on those ground rules, then let's continue. Karina, I'm assuming that you've already done your magic to get us on Facebook Live. And so I'm just going to continue on talking, and that we're recording. I'm sure we are recording. Yeah. So let's talk about the three phases of before we do that, I got to talk about the elephant in the room, because I forgot about this slide. Some people are wondering, so what's Mitch's real motivation for hosting this call? You're not asking for any money. So what's the deal? Are we going to have to buy Amway products at the end of this? No, there's no ulterior motive. Well, there is an ulterior motive, but it's not what you think. The reason I'm doing this call is two reasons. One, because I don't want to see people make the mistakes that I made. And I probably should make the confession now. I don't think I've ever said this in the call, but I'll just say it. I did not start my investing career in '99 doing financial analysis. The reason why I'm such a rabid advocate for it is because I didn't do it in the early days. And it's part of the reason why we got crushed in 2008, because we had no idea that our cash flows were paltry and that our returns were ridiculous. And so we went into 2008 thinking we were doing great because the deal looked like it made money, and turned out it didn't make money, and not nearly enough money. And we didn't find that out until way later. And so I'm not proposing this because I was perfect from day one. I'm proposing this workshop because I didn't do this, and it's what nearly killed us. And so if I can spare you that pain and suffering, I'd gladly do it. So that's reason number one. Reason number two is some of the people on this call either are or will be at some point in front of an actual deal. And your ability to analyze that deal and get it under contract is going to hinge on your skills in this kind of analysis. And maybe once you get that deal under contract, if you're looking for a partner, we could do some JVs down the road. Again, some of the folks on this call I'm JVing with now, but I see this as an opportunity to identify people and help people who might be able to be JV partners in the future. There's no commitment. You don't have to commit to that today, but maybe this makes that more likely. And if it does, that's great. And if I just get people to not make the mistakes that I made and to not buy deals that make no financial sense, then I'll consider myself to have succeeded. So what are the three phases of deal analysis as far as I'm concerned? They are as follows. First, you got to verify your inputs. Depending on what kind of model you're looking to follow, if you're a buy and hold or a fix and flip or a short-term rental or any asset class, there's a way that that asset class makes money. And in order to figure that out, you have to know what are the assumptions. In the case of a buy and hold, which is primarily what I've been doing for the last 20 some odd years, it's what does it rent for? How likely is it that I can keep a tenant in there? How much am I going to have to pay to get this thing? What's it worth? What kind of repairs does it need? What are the expenses? And some of those things that I just mentioned are guesses. Some of those are knowable, right? Or at least knowable within some reasonable range of certainty. So understanding how I gather my inputs and making sure that what I'm putting in is actually accurate is the first phase. Second phase is goal achievement. And again, if you've been on this call for any one of these, you know that I go through this every single time, and I'm doing it because it's important and I want people to understand that this is how you keep out of trouble. The only way that you can buy a deal that meets your goals is to have goals in the first place. When I first got started in '99 doing deals, I didn't have goals. If the deal produced money each month, I assumed that I was okay. And that's just not how it works. Just because you have money at the end of the month doesn't mean you're making money, because taxes may only be taken out once a year. And that may wipe out all the profit that you had, and you may not know it. So you got to have goals, and then you have to adjust your financial models to accommodate those goals. You don't change your goals. If you're looking for 10% cash on cash return and $200 a month positive cash flow, you don't run the deal and then see how you can fiddle with your finances and your expenses to make it come out to that. You set that as your end result, and you adjust the things that you can control, like price, to get you to a price that allows you to achieve your goals. But you're going to have expenses, and they're going to be what they are, whether you like it or not. So that's not going to change. But goal achievement assumes you have a goal, assumes you understand your goals, and that you can state what they are. And then finally, in my opinion, where the actual wealth gets created is the deal enhancement. Okay, got a good deal, makes sense. How could you make this deal better? How could you make it safer? How could you make it more likely to produce better returns over time? How can you minimize your risk? What are the things that you can do to fiddle with the deal in such a way that at the end of it, you're better off, or your buyers, your seller's better off, or both of you are better off? What is that magic that happens to make a good deal great, or a great deal awesome? So those are the three phases. Let's talk about them briefly. Again, I've covered this before, but I think it's important just to set the expectation. I'll talk about this in general. I'm looking over there because that's where my lunch is that I haven't eaten yet, and I'm hungry. So if I get cranky, you'll know why. The basics: after repair value, you can get that a variety of ways. The most reliable way is to get comparable sales. You can talk to an agent, but there's tons of ways to get it, but you need it. You need to know at least what this thing is worth if you fix it up. Fair market rent is crucial if you're going to be a buy and hold investor. You got to know what it's renting for. And just to be clear, fair market rent is not what the people in the property are paying right now, because they may be paying more or less than fair market. And if they're paying way less, then there's an opportunity perhaps to raise it up to market. But if they've got 5-year leases, then not so much. And if it's way over, that's great. But if they ever move out, you're going to go right back to fair market. So you need to understand what they're paying, sure, but also what is the actual market rent for that property. Repairs, we've talked about it a little bit last week. The bottom line is you're going to have to get someone to put eyes on this property and give you a reasonable approximation of what needs to be done. But you're always going to have, ideally, I hope, an inspection contingency in your agreement. So if you're off on the repairs and you do the inspection and discover a whole bunch of things that you didn't anticipate, you're going to adjust the price, or you're going to try to adjust the price. So you don't have to be down to the penny in repairs, but you should be in the ballpark. Property taxes are very knowable. You go to the county tax commissioner website, put in the address, it'll tell you, at least in Georgia, it'll tell you what the taxes are. And it'll tell you what the taxes have been for the last however many years you want to look back. So there's no excuse not to have property taxes. And insurance, same thing. There are insurance brokers who do nothing all day long but give quotes. You give them an address, you give them beds and baths, and they'll tell you, roughly speaking, how much an insurance policy will cost. So there's no reason not to do input verification and no reason not to get it right. So goal achievement, what really is required here is to have goals. I mean, the math for how do you calculate cash flow is standard. You can go on Google, you can Wikipedia, and it'll tell you how to calculate cash flow. Same thing with cash on cash return. I didn't invent either of those. But what I am saying is you've got to know before you start working on the deal what your cash flow minimum needs to be and what your cash on cash return needs to be, if those are your metrics. I'm not saying these are the only metrics, they are not by any stretch. But if you are a buy and hold investor, some version of these is going to be important. And I'm not going to get on my soapbox about cap rate, except to say that hopefully I've convinced you that, and plenty of other people have as well, that cap rate is not a measure of financial performance. Cap rate is an assessment of the climate in which the property is in, and it really makes no sense for single family houses. It really is intended for commercial real estate as a class in a particular market. So these aren't the only ones you can use, but whatever ones you use, stand by them and don't modify them based on how badly you want to do the deal. That's not investing, that's gambling and hoping for the best, and that rarely works out well. And then finally, I'm not going to spend a whole lot of time on this because it's a lot more useful when you talk about a specific deal, but there are plenty of ways that you can make a deal better, better for you, better for the seller. The example I typically give is financing. There are some cases, I was talking about to somebody today who was mentioning that they were talking to a seller and the seller said, look, I really don't want my cash right now. I really want my cash over time. I'd rather have my payments over time. And that's great for them. And it's also great for us because if we can buy with terms and not have to put all that money down up front, that massively reduces our risk and also our cost. So those are examples of deal enhancement. It's a lot easier to talk about this with specific cases, but that at least is an example of how you can make the deal better just by thinking. I'm not swinging a hammer, I'm not sawing any wood, I'm just sitting in my comfortable chair pondering what ways could I make this deal better. And if I can in 5-10 minutes come up with an idea that saves me $10,000, what is my earnings per hour on that time that I spent? So those are the three phases. Hopefully we've all kind of memorized these by now. Let's talk about today's deal. It is 117 Highland Park Drive in Athens, Georgia. It's a 2-story brick, at least 2-side brick. I can't see the other sides, but I think it is full brick. Triplex. It's 3 bedrooms, 1 bath, and 3 units. It's just over 4,000 square feet, built in '83. It may need some work on the inside, but it looks nice. I mean, I was impressed to see this one. Fairly newish roof, needs some paint and carpet, but nice looking deal. And our guest speaker, our presenter, is Kevin. I want to say it's Leonce. If I got it wrong, then shame on me. But that is Kevin's Bigger Pockets profile. I strongly recommend that if you're on this call, odds are you're on Bigger Pockets. And if you're on Bigger Pockets, you need to use that as a resource for finding other investors who are doing cool stuff and analyzing deals and being smart about how they invest, whether they're in your market or not. And maybe even easier if they're not, because you won't feel like they're competing against you. So I would recommend that you hit up Kevin after this call and congratulate him on doing such a great job. But that's the deal that we're going to review, and Kevin's going to be the one working through it. He can't do it until I stop sharing, so let me stop the share. But before I do, I just want to let you know that you can you can go to this bit.ly link and see his spreadsheet, and you can sing along with him if you like. See if someone's asking a question. Oh, thanks, Karina. Yeah, so it's now in the chat if you want to go right to the link and follow along. I'm going to stop sharing so that Kevin can start. And I think we're going to run a poll, or try to run a poll if we haven't already done it, while we're doing the transition. So Kevin, it's all yours. Nice. And if you were muted before, go ahead and unmute yourself and I will give you the floor.
Okay. Thanks, Mitch.
Awesome. All right. All yours.
All right. So this is a triplex in Athens. I have this spreadsheet basically with all the inputs and a summary presentation at the end in case that I'm presenting it to someone. So with respect to the price of the property, they were asking $245,000, and the rents are, this figure right now is the actual rent that the property is receiving, which is a bit below what the market rent is. So when I checked, market rents were in the range between $1,100 to $1,200 for a 3-bedroom in this area. And presently they are at $800, $775, and $850. So there's some room for improvement with respect to the rents. And ARV.
Hey, Kevin, before we leave rents, I'm sorry.
Yeah, sure.
Any reason why you think the seller is leaving $200 a month per property on the table? Have they given you any indication?
Well, these are tenants that have been there for a long period of time, a few years, things like 2 or 3 years. So the rents were small increments, small increase in the rents over the time, as well as the property needs some work. So I don't think they could achieve the market rents with the current condition of the property.
Got it. Okay.
Yeah.
Fair enough. So in the theme of phase one, I think we're going to move over to ARV. So let's talk about what you thought ARV would be.
Right. So there weren't many comparables in the area for ARV, and there were like 2 other triplexes, and the price range, one was, let me just find and pull that up. Two Highland Park, and that was sold last year for $250, and there was another one, it was $274, but that was sold quite a few years ago. This is from Realtor that I pulled these up, and in general, the 245, 250 range is what I had for the ARV on this property, based on those similar triplexes in the area. Most of the other properties were duplexes and single families, so couldn't really get other comparables of sold properties similar to this one.
Okay.
All right.
Before we move on, anyone have any differing opinions on ARV or, since we're here, rents? Anyone get anything dramatically different? Because I saw the same thing on the rents. I wanted to ask you about it because I couldn't think of any sensible reason why they'd be charging so much less. But you make a good point as to why they're doing it. I get it, but I saw the same thing you were seeing, and I guess that's part of the reason why you're looking to buy it, because you see opportunity to raise the rents. But
can I just make a quick comment? I'm not seeing Kevin's screen share anymore.
Oh yeah, I thought you went when you went to look at the other screen, Kevin. It's screen specific, so if you tell it one screen, it won't show us the other stuff.
Sorry.
Nina looks like she got higher on the rent. Nina, if you're available to tell us, what'd you get on the rent? You may not be, I can't tell if you're, well, you typed it, so you had to be able to chat. She's 3,600. Oh, so you got.
I don't know. When I did my research, I found that the rents would be around 3,600
total. So 1,200 each.
Yeah, 18, I guess, or just in total. Yeah, 30, 1,800.
Well, it's a triplex.
Oh yes, 1,200 each. Yes, correct.
Yeah, and that's roughly what Kevin got. So we're in that general ballpark, in theory at least. So okay, cool. So it looks like, Kevin, we're pretty much right with you on the rents and the ARV.
Right.
Let's talk about your other inputs, expenses and
Right.
such.
So insurances, I have 1660 for the year. That I got based on, well, I didn't speak to an agent, but I based it on another property that I have, which is a few streets away.
Okay.
And that is a duplex at 1200 with an older roof compared to this one. So I just thought that this would be a little bit more with that, given
Okay.
that information.
Okay.
All right. I have 5% general maintenance costs for miscellaneous repairs that may take place. Property managers costs 10%. I always put in other expenses because they're typically miscellaneous costs which you tend to miss. Maybe some landscaping maintenance which you have to take into account. As well as I sort of include in this as well the possibility of some sort of capital expenditure as well that may be deferred going down the road. So that's additional 5% here.
Okay.
Property taxes, well, for 2019, property taxes were around 2,000. So I just bumped that up a little bit more because it tends to increase on 1% or roughly around that per year. So I increased that to 2,200 to get a total annual expense for around 9,400 for the year.
Okay. Got it.
Yeah. Typically, I get my deals financed, but my interest rate is typically higher than what others would get. So that's this calculation here, debt servicing figure of 1,000 for the year, for the month, 12,000 for the year. And yeah, pretty much that's my inputs.
Let's talk about repairs. You have 5,000 for estimated repair costs.
Right. So over to the right, yeah, I put in some other assumptions and some other figures. So yeah, so the 5,000 that I have here for estimated repair costs, that specifically relates to there's a deck that's to the back of the property that is in need of a little bit of repair. So I just that alone, that cost alone is for the deck only. Nothing else typically needs any significant sort of cost right now. So that's why I factored in that 5,000 just for the deck itself.
Okay.
Yeah, and I just have other costs with respect to future growth of the income, expenses, and property values to the right-hand side here. And if it is that I'm selling it, closing costs, and actually the purchasing closing costs goes into here as well. I typically get other information, for example, school ratings, population as well, because I do this remotely and I don't live there. I just kind of need to get a better understanding of what job growth is like, what population growth is like, to know whether the property itself is in an area that will provide some sort of future rental and on a continuous basis, right? So pretty much all this just leads into a summary sheet, a presentation, which I have over here. Basically, you can put a picture and just description as to what it is. And this here, key metrics identifies all the information that we Everybody's still seeing the screen, right?
Yep, you're good.
Okay. All right. Yeah. So key metric just identifies what cash flow is like, net operating income, cash on cash return. I have gross rent multiplier. It helps with multifamily properties. Helps me identify well, let me explain the gross rent multiplier first. It's sort of a ratio, a relationship between the purchase price and the annual rent. So typically, the lower it is, the better it is. And it kind of identifies a payback period of how soon you will be able to get back the money on using just the gross rents on your purchase price. So I just typically include that to kind of help identify whether it's worth it or not.
Okay.
Yeah, the other stuff is typically not too specific to smaller deals like this, but yeah, this is the information that I pretty much put together to get whether it's a deal or not.
So for your triplex deal, for this specifically triplex deal, you'd be looking at $449 a month in total cash flow.
Cash flow 449, yes, as it is right now. Yeah.
In order to get that, you'd have to spend 5,000 repairs. You'd have to spend, what you have, 55,000 in down payment.
Right, so 70, that's this figure here, total cash. 70,
yeah, got it. Okay, cool. So, and that's why you've got a cash on cash of 7.6.
Right, and I typically look for 8% and above.
Okay. So anyone have any questions? I know we don't typically, Anthony is asking a question about vacancy.
Right, yeah, I have a 5% vacancy built in. That's over here. 5% per month, so a total of 1,455 for the year.
Got it. So your effective gross income is already taking into account vacancy.
Yes.
I will say, and again, I don't know the Athens market. In Metro Atlanta, I typically assume more like 8%. 5% assumes 1 month out of every 20 you're going to be good to go. Now, I realize these are long-term tenants, but it's kind of a balance because they're long-term tenants at 100, 200, 300 bucks below fair market. When you start to charge fair market, you might see a bit more vacancy. I personally, I'm okay with, I mean, I don't like vacancy, but I want to get tenants who are prepared to pay market rent more than I care about not having any vacancy.
Right.
So my recommendation is, and there are folks on this call who are not looking at the Atlanta market. So I'm not saying that the right number is 8.3%. What I'm saying is know your market, talk to other investors in your market and get a sense for what is the right number, but know that it will be not zero. I mean, you're going to have vacancy. People are going to eventually move out and you don't want to be surprised when it happens. So just be mindful of what that number is. And I tend to be more conservative on my numbers so that I'm not crushed when people move out.
Yeah.
Anthony, that answers your question. I see another question in the chat. Tim Harwick is asking, can you talk about the difference between Unit A rent and Unit B rent? I'm guessing these are actual, so I guess they leased one at one rate and the other one at a different rate.
Yeah. So if you look down below here, 775, 850, and 800. As to why they're different, the only explanation that I got was with respect to how long they have been there, and they haven't increased rents significantly over the period of time, and as well as because I guess the property is in need of a little bit of love, they just kept it at this and probably will increase it.
And since they probably moved in at different times, depending on what the market was, at the 70-75 person maybe got what they thought was fair market rent at the time. I doubt it, but that's why they're different, is because they didn't move in all at one time. It'd be a lot harder if they moved in at the exact same time to explain why you charge 3 different rates for the exact same square footage unit. But I suspect that's probably what's going on there. As an aside, I will say that my experience has been that if you tolerate fixer-upper properties, you will get fixer-upper tenants. And so the argument that, well, I'm keeping the rents low because, they don't complain too much about repairs, just tells me that they're wearing down your place and you don't know it. And the minute these folks do move out, you're going to discover all this deferred maintenance that they didn't bother you about, that you've now that someone's now got to deal with. So in addition to the 5,000 repairs, and I know you had mentioned to me that this was not a deal that worked out, but if I were looking at this deal, I would assume at least a good $5,000 per unit in deferred maintenance.
Okay.
Particularly because you're telling me, or they're telling me, or telling you that the rents are low because the tenants have been there such a long time. If the tenant's been in there for more than a year or two, and I'll typically ask, well, how often do you inspect? And if the answer is, what do you mean by inspect? As in they've never seen the inside and since they moved these people in, then it's almost a given that the place is, I won't say a wreck, but not nearly as pristine as you would like if you were the landlord. So obviously you're going to put eyes on it before you buy it, but my generic assumption is that it's going to need some basic, every single unit is going to need some basic renovation, not just when they move out, but right now, because I'm sure there's stuff that they're not telling anybody about that's wrong, that they're just tolerating because they don't want the landlord to raise the rent. And that's my concern about people who are willing to just settle because they know that they're getting a deal. And so they don't tell you when stuff's broken because they're afraid that you'll come back and penalize them by raising the rent. But that doesn't help you, because if it's a leak that's, a minor thing on day one, day 366, it's a massive problem now because it's been leaking for a year and they didn't tell you because they didn't want to raise the rent. So and again, this has nothing to do with this particular deal per se. I'm just throwing this out there in general, that this is, to me, the mark of a weak landlord. The fact that rents are below market, this far below. I mean, $50, okay. $200, $300, $400 below is, I mean, if fair market is $1,200, $1,300, we're talking significant money lost for each of these units every single month. And that's just, to me, there's no excuse for that. Either get better tenants and do the repairs, or don't be a landlord. But that's why they're selling to us. So I guess I shouldn't complain. But anyway, any other questions? Oh, see a bunch of questions. Someone's asking about CapEx. I think you covered that. For you, CapEx, you don't have a specific line item that says CapEx, but you sort of have that other expenses, 5%, that you think of as CapEx. So you could just as easily have called, what is that, C32 CapEx as other expenses.
Right.
That's a good question from Matthew. Any other questions from folks about the layout, the numbers? I will say, if you go back to the, Kevin, go back to the summary rental presentation, because I just want to, oh, that's a good question. Kamar asks about utilities. I assumed that utilities were separately metered, but it should probably be worth asking.
Yeah, they're separately metered, and the tenants
are responsible.
Are responsible for that. Yeah.
Cool. Now you would be responsible if this were someplace where it snowed. You'd be responsible for snow removal because it's a common area,
Right.
And I didn't see that there was a whole lot of lawn to care for. But if there was lawn to care for, or gutters and that kind of stuff, I suspect you'd be responsible for it. And trash, sewer, I assume that's all, well, typically sewer goes with water, but this just asked the question: is trash also independently handled, or is that something?
Yes, that's independently handled as well.
And sewer as well.
Yeah. So I have a category for all that, but because they're dealing with it.
Yep. So it's not your problem. Good question though, Kamar. But I wanted to talk about these other numbers, because I just want to make sure that we don't often do this. And for some reason, all the flies in the house are now trying to attack my lunch. So if you see me distracted, I'm trying to defend my steak salad from flying insects. So we talked about, so we all can agree that net operating income is basically your expenses minus, I mean, your income adjusted for vacancy minus your expenses before you throw in debt service.
Yes.
And then when you throw in debt service, you're looking at actual cash flow.
12.49.
And then when you look at cash flow, if you annualize that cash flow and divide it by the total cash needed, you've got your cash on cash return. And I know people probably think I'm in love with cash on cash return. I only like cash on cash return because it's simple. Everybody understands cash. I put this much cash in, I get that much cash out in the first year. The other numbers here, let's walk through them, because I'm not gonna diss them. I'm just gonna say purchase cap rate is, and you said this, Kevin, and it's true, for the purposes of this kind of property, it really doesn't matter. You can calculate all these things. They're all just equations, but that's not going to help you make any useful decisions, in my opinion. Gross rent multiplier, same thing. I mean, it's nice to have it, but because it's talking gross rents, in my mind, that's less than particularly useful, but it is a metric. It's a number. Margin and DSCR, your coverage ratios, all that stuff is mathematically calculable, but in my opinion, for a buy and hold investor, what you care about is at the end of the month, am I actually making any money? And doing it this way is way better than the way I was doing it before I started doing the analysis back in the early 90s. I'm sorry, the early thousandsies, I guess, the late 90s, 99 and between 99 and 2008, was we'd look at the end of a month. So you get this much rent, you pay this much in expenses, and this much is left. And oh, cool, I got money. Well, but that's not annualized, right? So if you have expenses that only hit once a year, then this analysis tells you, factors all those in, and the analysis that I was doing before the crash, which was no analysis at all, which was how much money is left in my bank account, was a horrible way of doing it, because in October, which is when taxes are due in Georgia, we'd have to write a big old check for annual taxes. And we wouldn't associate that with what we collected over the previous 10 months. And that could have wiped out all of that, and we wouldn't even know. And so without doing this analysis in advance to analyze the deal, you have no idea if you're making money or not. Just because you have money in your bank account in the first couple of months doesn't mean you're actually making money. And even if you have a positive cash flow, it doesn't mean it's worthwhile. 7.6 in this market is not horrible. And we'll talk in a minute about getting to phase 3, which we don't typically talk about. But if you've got a way of investing that generates consistently, if you had 2 deals, this one and one that's generating 9.5, then you can look at those 2 deals side by side and go, 7.6, 9.5, other things being equal, this deal is better. And that ability to analyze of all the deals that you're considering, which ones rise to the top, is impossible without some sort of an analysis. And that's why I'm harping on that point, because if you don't run the numbers, if you're not comfortable with the numbers, you won't do the math, you won't have any idea. And then your 2008 will come along and crush you, because you'll think you're making money, and in fact, you're not. Or you're thinking you're making enough money, and in fact, you're not making enough. You run the numbers and your cash flow is $75. Yeah, you're positive, but if the market goes even slightly under, if instead of getting full market rent, you're only getting 80%, maybe now you're negatively cash flowing and you wouldn't even know it. So I'm not going to harp too much on that, but I really want to slow this down and make sure that everybody that's on this call understands how we got these numbers, what they mean, at least the ones that I care about, cash flow and cash on cash return, what they mean, why they're important, and why you shouldn't be doing any kind of deal like this without running these numbers. If you can't tell me what your numbers are and how you got them, in my opinion, you're not an investor, and it's only a matter of time before you get squashed like a bug, which is exactly what happened to us in 2008. So I will pause and just ask if anyone has any questions or observations. And if not, sorry.
Oh, sorry. I was just wondering, the cash on cash return of 7.6%, does that include like the reserves that you started out with, or is that not including them?
No.
When you say reserves, you mean the CapEx reserves?
No, like let's say a 6-month reserve. When you're buying a property, it's smart to have about 6 months set aside in cash. So that's not included in that 7.6?
No,
it's
no,
not.
this is all deal specific. So this is for this particular, no, certainly you should have reserves, but yeah, this is just for this deal. How much cash you had to put in divided by how much cash, how much cash you're getting out divided by how much cash you had to put in.
Okay, okay. Thank you.
Sure, sure. And Kevin, you mentioned that you like to get 8% or better.
Yeah, I do.
So this one wouldn't have met your needs, even if we assume the estimated repairs were accurate, which I'm willing to bet hard money are not. I'm willing to bet that if you put eyes on this place, each individual unit would need at least 5,000 plus in repairs. So you're talking a good, going from 5 to maybe more like 20,000, which would make this more like a 6 to 5% cash to cash return deal. If I were going, so let's kind of segue into phase 3 because, well, let's finish phase 2 because I just want to talk about, and we don't talk about this a lot. Okay, so we ran our numbers and we got 7.6. Let's say you wanted 8.
Yeah.
How would you get 8? I mean, I know you know how to do it, but for the purposes of this, how would you get 8% cash on cash?
Well,
Would you
for
have?
one, with respect to my offer of 223, I probably would come down to a 200,000 and see if that will work. And
Okay, 10.5. So that's much better. And just to be clear, if you go back to the inputs, what you did not do, and I know you wouldn't do it, but some people would do this. What you did not do, if you scroll down a little bit, you didn't start going, well, how about we make the maintenance 4%? And well, how about we make the property management 9%? And well, how about, because those are fixed expenses. I mean, you decided what those were. We did that in phase 1, right? We set what those are up in phase 1. So we can't go back and start changing that arbitrarily. So those cannot be or should not be changed. Nor should you be changing things like your interest rate, because presumably the bank doesn't care about how good a deal this is. They're going to charge you whatever they're going to charge you. If you can get a lower rate, that's great, but you can't base that assumption on whether or not this deal meets your needs. If 6.6 is your cost of money, then that's your cost of money. And so you need to change, frankly, the one thing here that you can change, which is the price that you're going to pay. And as an aside, and I know we don't talk about this very often, but I think it's important to mention it. If you are wholesaling, if you are a wholesaler, then your wholesale fee is a function of what you can sell this for versus what you get this under contract for. So if let's assume that this deal is that this perspective is your end buyer and that you're a wholesaler, you're going to sell the deal to somebody at 200. That means if you want to make any money on this deal, you've got to get it less than 200. And however much less than 200 you get, that's your wholesale fee. You don't get to decide arbitrarily up front, you know what, I want to make $10,000 on this deal. No, if this deal only makes sense at 200 and you go to the seller and you can only negotiate a contract of, 199, then that means you've only earned $1,000 wholesale fee. And that's the most you can make because it's only worth this much to an investor and you can only get it for this much from your seller. And what's in the middle is your wholesale fee. People always ask me, how do you set your wholesale fee? You don't set your wholesale fee. Your wholesale fee emerges based on how little you can get the property for and how much you can sell it for. And you don't really control either of those. Well, you control the first one to the extent that you can negotiate what you have with the seller. But what it's worth to an investor, if you know your investors want 8%, or in this case, 10% or whatever the number is, then you have to run your numbers so that it makes sense for them to buy it from you at that price. So it's not like you can just take a contract that you get, slap $10,000 on it and put it out there and expect people to buy it. That's not how wholesaling works. And I know most of the people on the call understand that, but I just want people to understand that wholesaling is really not magic. It assumes that you can buy it so much cheaper than the average person that you can make money on the front end so that you can still sell it to your end buyer at a price that makes sense for them. Because that's the only reason why they're going to buy the deal. So everybody get that? Everybody understand? That's why people say, oh, I don't like buying from wholesalers. If the wholesaler is doing their job right, they should be presenting you deals that make sense to you. If you ran this investment property at 250, it doesn't work at 250 because A, it's pretty much the full price of the property, and B, your cash on cash would probably be next to nothing. So there's a limit to how much you can sell this property for, and there's a limit to how much skill you're going to have to need to get this at a bargain basement price. Whatever the delta is between those two numbers, that's your wholesale fee. That's your best possible wholesale fee. And if you're really skilled and you can get it really, really cheap and sell it really, really at the upper limit of what it's worth to an investor, then you get more. But it's not unlimited. You're not going to pull, $20,000 out of this deal just because you want it. I mean, I wish that's the way wholesaling works, but it doesn't. You pull what you can based on what you can get it for and what the market says you can sell it for. Any questions? We got a chat question. Let's see. Would raising the rent change cash on cash? Absolutely.
Yeah.
But you've got tenants in here, so you've got to respect their existing lease. Do you know how? I think you probably have it in here someplace, Kevin. What's the terms? Yeah, July of this year.
June.
Okay, June. So now, so these leases. Now, does that mean these are month to month, or that they really?
No, it wasn't month to month. It was a year lease. A renewed lease for a year.
So it just happens to end now. So now would be potentially a good time to buy this thing because you can write your own leases, and either these people accept those higher prices or they don't, and you put people in who actually can pay market rent. In that situation, the changing the rents. In fact, if you would indulge us, Kevin, and change the rents to the 3,600 that we think market is closer to. No, I'm good, but I can't reach. Yeah. Yeah, so 25% cash on cash. Now, again, a few other adjustments would need to be made because, again, the repairs right now are way too low. But maybe this brings it up to a reasonable 10% because the 10% we had before was science fictional. But to answer a couple of quick questions, so hopefully we answered your question about, Matthew, about raising the rent. Yes, it definitely, because it increases your income. So anything that increases your income is going to increase your net operating income and your cash flow, and therefore improve your cash on cash return. So that's a good question. Nina's question about what it means to invite your tenants to leave. Yes, when you're buying a property that has leases in place, you are buying the property, and you're also assuming the responsibility that the old landlord had for those leases. So you can't just break those leases because you bought it. So you've got to honor those leases. So if they have a 1-year lease starting now for 12 months at $775, you have no choice but to honor that lease if the tenant wants to stay. You could go to the tenant and say, hey, look, you have a 1-year lease at $775. If I fixed all the things that are broken in your property, would you be willing to pay a higher rent? And if they go, sure, then you could write a new lease. And now you'd have to work out the timing because you wouldn't want to make all those repairs and then have them say, no, I don't want to pay more. But it could be done. But if the leases end in June, then there's none of that needs to be done. The leases will terminate, and then you would do the repairs and just make it clear to them, look, if you're welcome to stay, but market rents are going to be, or the new rents on these properties are going to be this. And someone made the point that the repairs could bring higher rents, and frankly, and this is my position, better tenants, because a certain kind of tenant will tolerate substandard property. And my experience is I don't want those tenants. I want tenants who want nice looking, sharp looking properties. And this property looks nice from the outside. So unless it's trashed on the inside, I want fair market rent for it.
Oh, we have pictures of the inside.
Yeah, and I just see, and they look, I mean, nothing looks scary. I don't know how recent those pictures are.
That they are recent. That actually,
recent? Okay.
Yeah, the agent went and took pictures for me.
Do you know if this property, I think I know the answer, but I'll ask it anyway. Do you know if this property is professionally managed now?
No, I don't know, because I think, this didn't work out, but somebody else got it. So I'm not sure if they have a professional management company.
Got it. Yeah, I'd be willing to bet money, not a whole lot of money, but some money, that this was not professionally managed. If it were professionally managed, the professional property manager was performing below standard, because leaving this much money on the table is, I won't say it's criminal, but it's malpractice for a property manager. Any smart property manager would tell you, get the rents, and either these tenants can pay more, and if they can't pay more, then you find yourself tenants who can pay more. And yes, someone made the point that you can buy tenants out. We've done that before, and say, look, we're going to be raising the rents eventually once your lease finishes up. If you really can't afford to live here, how about we pay you a couple $100 to leave? Because we're going to raise the rents eventually, and when we do raise them, you're not going to get anything. So paying them to leave, you can't make them do it. But if they looked at that as a decent deal, and frankly, if you're going to have to move out anyway, it's not a bad deal, then yes, keys for cash is a viable strategy for getting tenants out, but you can't force them to. And so you'd want to, and if I were going to buy a property like this, I'd want to get that understanding in writing up front. In fact, I might consider setting it up so that on the day of closing, those leases go out and we get signed. Or actually, truth be told, it doesn't have to be in my name. I could have them sign that lease with the existing owner, and then just take it over once I buy it. But I want to protect myself. But yes, there are ways that you can't force them out, but there are ways that you can encourage them to leave. And if you pay them $200, that's 1 month of lost revenue, and you're already losing $300 to $400 a month by having it below market. So in my mind, that's a small price to pay to get them out and get somebody in there who can afford the new rent. You can have them move out by not renewing their lease, but that's not forcing them out. That's just, the lease is an agreement, and when the agreement terminates, you're not under any obligation to continue, and they're not under any obligation to stay. So the question is, your lease is up, do you want to stay? And they could either say yes or they say no. And if they say yes, then you explain to them, well, I understand. Thank you so much for staying with us. Here's the new rent in your place. And then at that point, they decide either they want to continue to stick around or not, but you're not forcing them out if you don't extend their lease. There's no obligation that you have, unless the lease says it, to extend their lease. You just have to honor the lease until it terminates. But yes, not renewing the lease is a way to get rid of inherited tenants. And what I typically do to avoid there being any issues of any legalities is I'll increase the rent and explain to the existing tenants what we're about to do. Because it's not that I don't want them. If they can afford to pay it, I'll happily take them. But because they've already been in there, I'd rather not have to do the turnover. But if they can't afford to pay it, I want them to understand that this is the new rent. And you're welcome to stay at this new rent, but if you can't afford to pay it, I understand, but you're going to have to move out when your lease is up. So I think we've covered phase 2 in some detail. We talked about what to do and what not to do. Obviously, you should not be adjusting your assumptions because you didn't get your numbers. Your assumptions aren't going to change. The taxes aren't going to get lower because you didn't get the cash on cash you wanted. So resist the urge to fiddle with that stuff just to make the numbers work so that you can do the deal, because that defeats the whole purpose of the analysis. Kevin, you're getting a question. Tim would like you to talk about the quality of the neighborhood to the extent that you have a sense for that.
I would say it's a B- neighborhood.
Okay.
If that makes sense to you, it's right close to the schools, easy access to downtown. Athens is probably like 6-7 minutes away. It's right in the hub of everything, and there's a lot of activity going on in that area, a lot of growth in that area, and then also there is proposals to extend and develop the area, and that is within the path of that progress. So it's a up and coming area, so it's going to have a lot of improvement going on. With respect to crime in the area, there's little to none in the area. You may have 1 or 2 incidents, but nothing significant to say that you need to stay out of that area or anything like that.
Nice. Cool. So of course, the advice, the overarching advice for buy and hold is you can't afford A's. You don't really want A properties because they cost too much and it's hard to make them cash flows. You don't really want C's because you don't want the hassle and the turnover. That B's, B minus, B plus, those are the kind of property, maybe even C plus if it's really good C plus. That's really the sweet spot for buy and hold investing. You want stuff that's affordable, not high-end polished gems because those cost too much, generally speaking, but also not, I'm afraid to walk get out of my car when I pull up after sundown properties either, because those are hard to keep filled, and everything else that you do with that property is going to cost you more. Getting contractors to go out there is going to cost you. Getting someone willing to property manage it is going to cost you more. And those, just for the record, those expenses don't always get taken into account when people do the analysis. They go, well, if it's a C plus property, it's 10%. If it's a property, it's 10%. No, you're going to get, if you ask somebody, how much do you charge to manage a property in the worst neighborhoods? If they even do it, if you can even find someone to do it, they're going to charge a premium because of the hassle factor. So a common mistake that people make on their spreadsheets is they assume that the neighborhood doesn't matter. So let me answer these questions in order. One question from Nina was, if you don't have access to MLS, how do you figure out the ARV? You can use Zillow, you can use Realtor.com. Here's my best advice. My best advice is make friends with a local real estate agent. And one of the best ways to do that is bigger pockets. When I look at a market that's outside of, well, everything is outside of Clovis, but outside of Atlanta, which is where I do a lot of my investing, I'll look on bigger pockets and see who the realtors are. I'll look up realtor in Cincinnati or whatever, and then I'll find out who's there, and I'll message them and say, hey, I got a property at 123 Main Street. I'm trying to get a sense for what it's worth. Would you, help a guy out and give me a rough idea what you think it'd be worth? Or would you be willing to have a 5-minute conversation about that neighborhood? And in 5 minutes, I can get them on the phone. They can bang it out, and I'm good to go. And if I'm really smart, which I try to be, I'll shoot them a $25 or a $10 Starbucks gift certificate for their time and effort, because the next time I have an issue, they're going to answer my phone call. So yes, you can use those sites, but there's no replacement for having the actual data. And most of that data is accessible only through the paywall or access wall of the MLS system. So get yourself an agent bestie in the market that you're looking for. And in 5, 10, 15 minutes, and in fact, maybe get more than one so you can kind of triangulate. But that's an easy thing to solve, and bigger pockets is the solution, because you got all these people out there who are investing just like you. Ask them to help you out. I've never had anyone say no to me on bigger pockets. It costs them very little, and who knows when they'll need your help. So that answers that, I hope. The question about the difference between B and C, I'll just give you my perspective. I'll let Kevin answer for his perspective. For me, A property, I think we all know. A property is the top of the pyramid, top dollar rental. For the most part, if you have to ask, you can't afford it kind of stuff. Everybody knows what that looks like, and everybody knows what D and F looks like. It's I'm afraid to get out of the car at dark, and you ask a contractor if they'd go out there, and they go, "What's the address again?" No, I don't service that area. So everybody knows the high end and the low end. What's the middle look like? The middle looks like, for me at least, it looks like well-maintained lawns, mostly owners, not renters. So my mind, B is mostly owners, not renters. C is mostly renters, not owners. But for the most part, well-kept lawns, no dogs tied to trees, no cars up on cinder blocks, places where you walk down the street and you go, wow, this is a nice neighborhood. If I feel that, and from a psychographic standpoint, it's would the average, in my opinion, blue collar person, someone who's got a job, working in a factory would be the actual example, but somebody who's not making a ton of money but has a family, wife, kids, whatever, would they be comfortable living here for the long term? And if the answer is yeah, then I call that a B. If it's mostly owners and a few renters, I call that a B. If it's mostly renters and a few owners, I call that a C. and I'd still do both. It's just a question of, you know, where on that spectrum you are. Kevin, what are your thoughts about B versus C versus A?
Yeah, so A is like high end, as you said. My B and C is more of a middle class, middle income type earners. You're gonna have nice areas, well kept. You're gonna find a lot of, you're gonna find renters and homeowners mingle in between, and that is what I would kind of consider more of a B minus, where you have both kind of mixed in between, and it could be a C plus as well. Additionally, how I typically look at it is, if I walk through the neighborhood, would I feel comfortable? And if it is, I feel like I have to kind of be looking over my shoulder or looking around to see what made that noise or something like that, then I know that type of neighborhood is more of a D and lower. If it is that I'm walking in the neighborhood, I'm feeling okay, you know, not really strange, then I know I'm more in a B neighborhood. And if it is I'm walking in the neighborhood, everybody's watching me, well, then I think that's an A, and, you know, that's kind of like how I kind of, so.
Yeah, that's pretty much my take as well. Jason's commenting that he uses PropStream for ARV. There's a lot of services that you can use for ARV. All I suggest for ARV is that you use more than one source and confirm it, and nothing takes the place of someone who actually works that market. So even better than an agent is a property manager, because there's nothing nicer than hearing someone say, oh, I just filled one of these last week, or I just sold one of these last week, 2 doors down, and it was this, because that's about as ARV as you're going to get, assuming that the properties are comparable. So knowing the ground level mechanics of the market is something that property managers do, and talking to them is going to be the fastest way to get inside information. And when you're out of state, that's even more. I mean, again, keep in mind, I'm in Clovis, New Mexico. Everything is out of state for me. All the investing I do is someplace other than here. So I feel you, those of you who are saying you're out of state. I feel for my clients who are out overseas, because they're not here and they don't have access to the local market, and people aren't traveling. That's why, and I'll play this broken record, that's why Bigger Pockets is so critical, because you can hop on there and in 5 minutes you can find 10 people in your market. And everybody's trying to be, at least I've yet to find people who aren't supportive on there. So if someone came to me and said, hey, you know, there's a property down the street from you in Clovis, can you walk the neighborhood and give me a rough idea? I'd probably do it. I mean, the odds of that happening are pretty slim, but I'd do it. And I'd even be more inclined to do it if they had already hooked me up with some offers, some advice down the road. So my point is, use each other as your network, because that's where the special sauce is. Having basically a worldwide, or at least a US-wide network of people that are willing to do little favors for you, so that you do little favors for them, and you all get successful. That's the beauty of this. I mean, and that's, you know, I have leveraged that tool very effectively in the last 5 years, as evidenced by the fact that you're all on this call. So use each other, help each other in markets that you're in, and you'll find that most people are willing to tell you, oh, you know what, that zip code, be very careful in that neighborhood, or you know, what scares me about Atlanta, the reason why I don't do a lot of the city of Atlanta properties is because it's very, very fragmented. You go 2 blocks in the wrong direction. This block, $500,000 properties. You go 2 blocks in the wrong direction, and it's hardcore hood. And you don't know, I don't know what direction that 2 blocks is. Is it this way? Is it that way? Someone who lives there, who knows that market, can tell you, oh, if you go to this street, don't go there. If you go this street, you're fine. And that level of volatility, I don't need in my life. But if you're working that market, you know the answer, and you happily tell somebody. I mean, it doesn't cost you anything to say, hey, don't do this, but I recommend you do that, or at least be careful about this. So the answer to your question is, use your network. I've said this many, many times on this call and in other forums. Use your network to help you make smart decisions. And a broker should be a broker, and or a property manager should be part of your network in whatever your market you're trying to invest in. Even if you don't pay heed to my advice and manage it yourself, you should at least know who the property managers in that market are. And I'll just say this one last thing, and then I'm done for that. If you know property managers in your market, let's use example, Atlanta as an example. If I know Atlanta property managers and I'm dead set on marketing it myself, and they just filled a property half a mile away from my property, inevitably when properties get filled, there's like 5 other people who wanted that property who couldn't act fast enough. 5 people applied, 1 person got it. Well, what if I go back to that property manager and say, hey, for the 4 people that didn't get it, that still need a place to live, are you okay with sharing their names? And if I can fill one of these people, I'll pay you half a month's rent. I'd pay you, it'd be worth it to me to be able to get people who are already effectively pre-qualified. I still qualify them myself, but at least they're out looking, they were serious. And I can say, hey, here's my house 2 doors away or 2 blocks away. And if I can get any of those folks to do my application and get in, it costs me nothing for marketing. I made a phone call and I got this thing filled in days, and it costs nothing to do that. I don't know why everybody doesn't employ that strategy. So to reiterate, you should know a property manager, at least one good property manager, and at least one good real estate agent. They could be the same person in any market that you're investing in, even if you are committed to managing it yourself, which you shouldn't be, but that's a whole different story. Kevin, I'm going to ask you, I want to spend a little bit of time, maybe like 2 or 3 minutes talking about phase 3. I know you didn't do this deal, but let's talk about what ways you could have seen to enhance this deal other than the one that we talked about, which was to fix it up and therefore get better rents. Other than that strategy, what else could you do to make this a better deal for you or for the seller or for both of you?
To make this a better deal?
Mm-hmm.
That's a good question.
Let me make a suggestion, and you'll probably see where I'm going with this. If the seller, and I guess this is only a matter of going to be relevant, if the seller was an individual, it could be done with the seller being an institution. But I would ask the question. I think I talked about this last call. So, Mr. Seller, is it the case that you need all your money up front? And I've asked it better than that. But my point is, if your seller has had this property for a decade and has a ton of equity in this thing, and when they sell it, all that equity is going to hit their tax form, and they're going to have to pay taxes on it, they may be okay with getting, let's say they didn't have any debt on it. They may be okay with getting $200,000-ish spread out over time, over the next 10, 20, 30 years, maybe not 30, but however long you can get it. And if they'd be willing to consider taking not all $200,000 up front at closing, but maybe some up front now and then payments over time for the rest of it, because that's what they're getting now, right? They're getting below fair market rents on this thing. God knows if they're even making any money on this thing, but let's see what they are. Whatever they're getting right now, if you can match that payment with, as an owner finance deal, then you can kick your, 6.6% bank to the curb. You can kick that $57,000 or $50,000, having to actively defend my food here, $50,000 in down payment, because maybe they'd be willing to take $20,000 or $30,000. And so that is, and again, I don't know the circumstances of this particular seller. I know this deal has already been sold. But my point is, and I guess if there's one common theme that will always come up for me in phase 3, is you should always, always, always find out if the seller is needing all their money up front, which is the same thing as asking if they'd be willing to do seller financing. But if you ask that question, hey, Mr. Seller, do you want to do seller financing? The answer is almost always going to be no. So don't ask that question that way. Instead, find out what they're planning to do with the money. Looks like you did really well for yourself on this deal, Mr. Seller. You got big plans for all that money you're going to make? Oh yeah, I'm going to buy a boat for $200,000. Okay, well that means that they probably need all their money. But if they say, I got this and a few other duplexes that I'm going to hold on to, I'm good for now. I'll probably just, stick it in a bank someplace. Then you might ask them, well, gosh, what kind of return are you going to get when you stick it in the bank? And what if I could offer you 10 times that return? Because banks right now are paying what, 1%, 2%? What if I offered you, maybe not 20%, maybe I offered you 5% on your money? 5% is way less than what you're paying here, or what you would have been paying here. And dealing with the individual means There's no appraisal. There's no junk fees. There's no, you know, points typically. I mean, all those expenses go away. And you're dealing with an individual, not with a bank. You're not having to personally guarantee the loan, which the bank is absolutely going to require you to do. And so it's like 1,000 times better than going through a bank, and it's going to be a way faster. And all it takes is asking the question. You should always ask the question in a way that gets you a legitimate answer. And if they really do need their money, then no harm done. You move on to the next subject. But if they go, I don't know, I haven't figured it out yet, I'll stick it in the bank and see what's out there. Or I'm retired, I'm gonna just kind of relax and sit on the beach and look at the tide go out, then that's a perfect opportunity for you to find out if they'd be open to seller financing. This, I mean, not to pick on this person, but this was not a stellar landlord. If they managed it themselves or if they hired a property management company, they weren't watching their investment that carefully. They let at least, 200 times $600 a month walk out the door every month by not doing the repairs. So they're not, in my opinion, doing this for the money. And so you may be able to get this deal financed. And if you could get this deal financed, all sorts of things open up for you. So that would be my biggest suggestion for phase 3, is to ask about that, because that may benefit them from a tax standpoint, and it would definitely benefit you, because and we could run the numbers. I mean, if you dropped your interest rate to 5, and we probably don't have time to go through it right now, but if you dropped interest rate to 5, drop the down payment to like 10%, your cash on cash goes through the roof, because you're putting out less money. I mean, it's just as simple as that. And oh, by the way, when you're paying an individual, they don't care about amortization. Banks care about amortization because they want to get their money back, because they're anxious for every minute that they're exposed. This person who's selling the property, if you don't pay them, they're just going to foreclose on you and take it back, and they're going to be right back where they were, except they get to keep your down payment. So they wish you would default on their note. So you could set this up so there's no amortization. Right now, this 966.28 is amortized, right?
Yeah.
Imagine if that were just simple interest.
Right.
I mean, so again, I know I sound like the seller financing fairy, but my only point is that we got our start doing seller financing, and seller finance deals, when you structure them right, are like gold. And so that would be my favorite phase 3 strategies, to ask the question, can you structure this as an owner finance deal? And then you get to play with all these buttons: how much down, how much a month, what term. And that's the fun part. That's where you get to create massive value. It's not impossible to do 0% financing deals. It's not an impossibility. We've done it before. You set it up, the person gets their payments back, but it's principal. I mean, it's interest only until the amount is due, but if it's interest at all. But in some cases, we can set it up so that it's principal, 100% principal, no interest at all. So you're getting interest-free money. Every single payment you make is going right to your bottom line. It doesn't get any better than that, folks. So I don't want to beat this dead horse too much, but I did want to mention, man, these bugs are just flocking in here trying to get my food. I did want to mention that is a very effective and powerful phase 3 strategy. We're past the half-hour mark. So let me just ask if anyone has any last questions before we let Kevin go. Kevin, you did an excellent job, by the way. I think other people in the chat are making that observation. Congratulations on doing a very good job. Sorry you didn't get this deal, but you clearly know how to analyze, and so you'll be getting more deals. Any questions from folks? Any last-minute comments? If not, I'm guessing Karina has already asked the second of our polling questions. I will just let you know that we have a call scheduled for next Thursday, the 25th. The link, if you've seen all the other links, you could probably guess what the format's going to be. It's going to be DDDJUN25, but we'll send out the link tomorrow to invite you all to join us. I hope you got something out of this. Oh yeah, and it's also in the chat. Hope you got something out of this, and that you feel more comfortable about the ability to analyze deals yourself. I thank you all for being here, and we'll see you next week.